Hi everyone, welcome to today's webinar. My name is Fawad Razaqzada, market analyst with Think Markets, and joining us in the room is my colleague Victor. Hi Victor.
Hello.
Hope it's all right with you now.
Yeah.
Excellent. So yeah, we had a few issues to get this webinar started, but finally it's up and running. Thank you so much for your patience, and I hope we can share some interesting insights with you guys today. Now, for those of you who are watching this on YouTube, please make sure to join us live next time, because this will give you an opportunity to ask us questions on any particular market you're interested in. Okay, so before we begin, please have a quick read through the risk warning and the disclaimer. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any losses you incur, either directly or indirectly arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. All right, moving on swiftly. And as we mention every week, this webinar happens every Tuesday, 11:30 London time. It's mostly technically driven, but with the help of Victor, we do touch on the fundamentals as well, and there will be a Q&A session. Now, in terms of this week, there are not many major macro events to look forward to be honest. There are a few exceptions. Does anything stand out to you, Victor, in this economic calendar? I think the RBNZ meeting on Wednesday for me.
Yeah, for Kiwi traders, I suppose this is pretty key.
Yeah.
I think that I would be very keen to get Friday's data, which is pretty important, I think, in terms of the U.S. economy.
Yeah.
We just heard probably 10 minutes ago from the CEO of Morgan Stanley, who said that he expects the Fed to start tapering before the end of the year, and the first hike from them in the beginning of 2022.
All right, interesting.
So that's more that's some hawkish talk from the leader of one of the major U.S. banks.
Yeah.
So I suppose that banks are starting to prepare for normalization in terms of policy. So let's see if such materializes. Certainly, from the standpoint of the U.S. dollar, it seems like it's still in around these key levels, and it's so it's such a crossroad right here and right now. Very important levels both for bears and for bulls. So let's see how this concludes. So we have had a week full of ranges, and nothing but that is going to take us out of these ranges.
Absolutely, yeah. It's going to be, as you mentioned, there's not many macro events that could move the dollar out of these current ranges. But technically, the dollar is still in a downward trend as we transition to the technical analysis and live charts. And I wonder if the dollar is going to test the 2021 low before the Friday's data is released, because one thing you have to remember is the momentum, and momentum has been bearish for the dollar. But yeah, like there's no fresh reasons, I suppose, is what you're saying, Victor, to cause the dollar to.
Yeah, no fresh catalysts really.
Yeah.
We just had another attempt this morning to break through some key levels, and we're stalled.
Yeah. So it could be a long wait then until Friday, perhaps. Who knows? we'll obviously take it from one level to the next to see if there is any changes in technical buying and selling, obviously. And so far as the dollar index is concerned, you know, it keeps on printing new lower lows and lower highs. So for as long as that trend remains intact, the path of least resistance for the dollar, even if it's going to consolidate for a few days, it's still going to be to the downside until the charts tell us otherwise. So right now,
until it isn't.
until it isn't exactly. So right now, the invalidation level for me is this level here, which was the most recent high prior to the index making a lower low beneath this low. So it's possible that the dollar may come back a little bit and go back within the prior range, but that will still not necessarily mean that the trend is over. It would mean that the trend is has weakened, but it will only be bullish once we have a higher high in place, and specifically if we move above this high right here. So the dollar index is obviously very close to the 2021 low, which was hit in January, and last year's low, which was hit in December. These levels are very important, and you can see we came very close to that level before bouncing back this morning. I reckon it's very likely that these levels will be taken out either this week or in the next few days, you know, or early next week, before the dollar has any chance of staging a major recovery, because we are very close to these levels. If we were a bit far from them, then perhaps you could argue that maybe we would be looking to create a higher low at some around somewhere around, you know, 91 or 90 50 or thereabouts. But because we're so close to these levels, I think it's very likely that these levels will be taken out. What we may see is a drop below, and then a quick recovery and a rejection, creating a potential false breakout scenario, which would then be considered a bullish scenario insofar as the technicals are concerned. So we'll cross that bridge if and when we get there. But as we go towards the major currency pairs now and look at the euro dollar first, the euro dollar is still showing resilience, and it continues to frustrate the sellers. Each time it has printed bearish looking candles, we continue to see new highs. So this is the drawing we had plotted on this chart, I think a couple of weeks ago, and it still remains valid, right? Because prices continue to make higher highs and higher lows. And this was the previous high, which has now been taken out, as you can see today. So now we have a new area of support for the bulls to defend around here somewhere. So it needs to hold above this green shaded area for the short-term bullish bias to remain intact. If it doesn't, and if it goes below this region, then it would only turn bearish once we have a lower low in place. I think we can move this up a little bit, maybe below this low, but that would only be a short-term invalidation. So let me just.
Well, yeah, we've had this pretty tight range over the past 5 days, between 121.60 and 122.50-ish. So we, as I just mentioned, we have been testing to 122.50 so far this morning. So for now, there is no conclusive break that I would say is indicative of a major break. And you know, it's until we get that, I would sit on the sidelines here and look for further developments to avoid this chop that's going on over the past several days.
Yeah, so I think maybe if we get a daily close above this zone, I think that might be might be what Victor is looking for. And in that case,
so then it remains to be seen whether we get a close above or below this red line that you have just drawn. So let's see how that goes.
Yeah. So if that level gets broken on a daily closing basis,
both ways.
Exactly. Yeah. If it gets broken on a daily closing basis, I think the next logical area for the market to reach out for would be this high here, above which there will be lots of stops resting from trapped sellers around here somewhere. So that's why I think it's going to do that. If we get close to it, move up in a sharp move to take out those orders. And then eventually, my ultimate objective would be the 125 psychologically important level, which you can see on the longer term charts. If you go to the weekly, for example, it's somewhere around here, 125, which was where in 2018 the euro dollar sold off from. I'm not saying that it will do the same thing again, but we may see some reaction around that level if we get there. In terms of the bearish argument, right now there's not many reasons to be bearish on this market because the sellers are continuing to get trapped. There's no evidence of price breaking down yet. Indeed, the 200-day moving average is rising. The 21-day exponential is also rising. Both of them are objectively telling us that the path of least resistance remains to the upside. So there's no point in trying to fight this, is what I'm saying. But if you do get a reversal, then that's when you could step in on the short side. Until such a reversal is seen, be cautious if you're trying to sell this market. Fundamentally, the dollar remains under pressure because of ongoing risk rally. The dollar has become a funding currency. The Federal Reserve continues to think that the inflation is going to be transitory and that they're not going to tighten their belt anytime soon. The market agrees, and we have seen new record highs for the major global indices. The DAX hit a new record high this morning. Other European indices are rising to multi-year highs or new records. In the US, technology sector has rebounded after concerns rose about a potential hike from the Fed, which led to a sell-off a few weeks ago. But now the technology sector has recovered again, and we may see new record highs once again. So that's what's kind of driving the markets, is optimism about the reopening of the global economy, as well as expectations that central banks will not be tightening their respective monetary policies, kind of providing the Goldilocks scenario for risk assets across the board.
Risk assets.
Yeah.
So speaking of risk assets, shall we touch on the riskiest of them all?
Sure. This one?
Yeah, there you go. This one. So we have seen 50% correction in most cryptocurrencies, at least 50% correction in most cryptocurrencies, I should say. Some have suffered more than that. The ongoing Twitter-rama from Elon Musk is really driving this market, which is very worrying for me. If it would be very worrying for me if I was an investor in cryptocurrencies. Like if you have this supposedly decentralized asset class that is looking at the tweets of one person in order to take its next direction. So
He's become the central banker of cryptos, hasn't he? Like how the Fed Chair Jay Powell moves the dollar, he moves crypto markets with just one tweet, or should I say Donald Trump? He used to tweet a lot about the markets, didn't he? About China, and now replaced by Elon Musk. So they have something in common.
What do you see from a technical perspective here?
I see congestion here, which is going to resolve one way or another soon. Right now, it's really not very clear which direction it wants to go. But because we had this $35,000 level, tried to break through it several times, couldn't really get any downside follow through. That's the first indication to me that perhaps Bitcoin is trying to form a low around current levels. So what we need to see is a decisive break away from this congestion zone, and specifically a move above 40,000 on a daily closing basis. I think would now be would be a bullish development insofar as the technicals are concerned. But if you move back below 35,000 on a daily closing, then that would kind of nullify that argument, because it would indicate that people who bought on the back of yesterday's bullish close, they will have been trapped. So if you're bullish on Bitcoin, you don't want to see price go below 35,000 again. When I say if you're bullish, obviously I mean short term. Maybe you want to see Bitcoin go down even to even below 30,000 because you want to be looking to buy the dip. But yeah, short term, if you're heavily long and leveraged as well, then the best course of scenario would be for price to stay above 35,000 and then it starts to move above 40, and then that could then trigger fresh technical buying to take us towards 50,000, I think. What do you think, Victor? Do you have any clear view?
So from my perspective, this asset has become way too volatile to invest in right now.
Yeah.
And basically, the signal for me to buy cryptocurrencies would be when volatility subsides somewhat.
Right.
Like when we stop seeing these moves of 10, 15% per day, maybe it's worth a shot.
Yeah.
That may not happen anytime soon, but this is like my personal comfort is basically to invest in something when it's not that volatile.
Yeah. I mean, the volatility is not bad. If you're an active trader, you should be loving this volatility, right? Buy support, sell resistance. You'll get lots of opportunities that way. But if you're one of those longer term buy and hold type of investor, like the type that Victor, you are probably referring to right now.
Yeah. Well,
then perhaps
mostly cryptocurrencies have, at least of the people I know that trade cryptocurrencies are usually, invest in cryptocurrencies are usually not that active.
Right.
Say they buy something and they wait for it to go up.
Yeah. But this sort of volatility
that may not happen.
Yeah.
So, let's see.
Yeah, but I mentioned volatility. You mentioned volatility there. Right now, you're not getting the sort of volatility anywhere else, right? The stock indices are just going up and up and up. FX is just going sideways in most cases, and the range, if you're lucky, you'll probably get like 100 pips a day in the pound dollar maybe. But yeah, volatility is really constrained in other markets, but in cryptos, it's quite active. So if volatility is your thing, trading cryptos is probably the place to be right now.
Could be worth a shot.
Yeah, this one, Ethereum, is one I was looking at. Yesterday, it closed above this hammer candle. You see this hammer we formed
Yeah.
on Sunday? Um, Yesterday, it closed above it. And today, it's testing the high of that hammer candle at $2,382. So I reckon Ethereum is going to bounce from here. And if it can hold the bounce, then possibly it could go all the way to test this breakdown area, which was previously providing support. So out of the two cryptos that we've looked at, I like the look of Ethereum more, or Ether, I should say, compared to Bitcoin. So yeah, this is the key level. If it breaks down, then the next level on the way down would be maybe 2000, yeah, around there somewhere. And then below that, there's nothing really until the 200-day moving average, which comes in exactly or roughly where the 2018 high comes into place. Now, if you zoom out to the weekly, you will see this was the previous record high hit in 2018. So that would be the next key support to watch should we break down below these levels I mentioned. Do you have any other cryptocurrency you want to look at, Victor? I think we lost Victor.
Apologies, I was on mute.
Oh, okay, no worries.
Well, I don't personally have any other favorites. I mean, when I trade cryptocurrencies, those are the two that I usually trade. I'm not among the opportunists with Dogecoin.
Okay, cool. Sounds good. Let's move on then and go back to the FX markets and just look at one or two more currency pairs, and then we'll go.
Yeah, I was gonna say that we could probably have a look at commodity currencies.
Commodity currencies, yeah.
Particularly because of some news overnight from China.
Yeah.
That once again they did this last week, and this week again they are reiterating that they're watching commodity prices very closely, and they are ready to take measures. As some of you might know, China actually has huge stockpiles of commodities, and they can actually, if they are willing, they can impact prices in a significant way. So particularly Aussie dollar traders should watch out for developments on this side of the spectrum.
Right. So if commodity prices were slapped down, would this push the Aussie dollar lower, do you think?
Yeah, sure. I think so. The central bank has not been very hawkish recently. They have huge piles of debt, particularly in the housing market. So they're not that keen to hike rates.
Okay.
And I would say that the Aussie's status as a high yielding currency is, it's not that high yielding anymore.
Yeah, that's true. And it's been reflected in price action going sideways ever since start of this year. It hasn't really gone anywhere. It tried to attempt a breakout in February, but it failed. And since then, it's gone back within its prior ranges. So this is a sideways market. And perhaps the best course of action would be to wait for a breakout, either to the upside or to the downside, and then trade it in the direction of the breakout. So currently it's residing in this triangle pattern around the 21-day exponential moving average. If it does break through resistance in this shaded area, then looking to go long on the retest of that would make sense.
Just a note on a quick note,
Yeah.
if I may, on the 10-year, the Australian 10-year yield is at 1.63%, whilst the US 10-year is at 1.61%. So the days of the carry trade by buying Aussie dollars is pretty much gone.
I'm trying to look for that yield chart that you mentioned. Oh, hold on, I've got this comparison here. Yeah, so you can see they're very close to each other. Australia is in purple, and the US is in blue.
Yeah,
and that's the difference. Yeah.
So basically, the Australian yield did rally in tandem, I would say, with commodity prices.
Yeah.
The move has plateaued since March, and we haven't seen any new developments on that end.
Right. So does this imply, therefore, that if you are looking for new ideas, perhaps because Germany is still in negative, it's below zero, right? Do you think that would be something to consider then, going long the euro dollar rather than long the Aussie dollar, because that there's potential for the German yields to close the gap? Or do you not necessarily see that?
No, I don't. To be honest, I would say that if yields start to go higher, I would bet my money on the US, because traditionally the Fed is the first central bank to hike rates after a recession.
That's true.
It's either the US or the UK. Since the UK has Brexit going on, I doubt it's going to be the UK this time around.
Yeah.
So,
well, the UK has been quite successful in bringing down virus cases and opening the economy, at least at the third time of asking. So I would argue that possibly the pound dollar could be a good candidate for looking to buy the dips in, compared to the euro.
yeah,
but yeah, as you can see, yields in the UK,
especially if you look at the euro pound chart.
Yeah.
On that end, we can certainly see that something has been going on over the past several months, really.
Yeah.
Especially since the beginning of the year, this move lower in the euro pound has accelerated. The pound has been gaining ground, not very recently. The rally has paused. We are seeing some consolidation, but after probably about 7 cents of a move. Sorry, 7 pence. I would say that it's normal to see this type of consolidation, and as long as we remain below the 87 level, that appears to be quite strong and to be quite key. I think that this trade is safe it's safe to buy the pound on dips towards that area.
Yeah. Okay, so since we are talking about the pound, this is looking like a very messy chart right now on the cable. But it has done what we had expected generally, but it's struggling to.
We still don't have a break higher though.
Above the 2000, the January, February high.
Even today, a move above 142 was swiftly rejected, and we're currently testing the lower ends of the range, at least for today. So let's see how that goes.
Yeah. So obviously, with the pound struggling a little bit, this should be good news for the FTSE, because there's a very strong correlation between the FTSE and and the pound, or it has been in the past. Now the FTSE is a really struggling index, I would say. It has really lagged behind the global indices. Yes, it has come up, since bottoming out.
Do you think that's because it's relatively low on tech names?
Absolutely, yeah. I think the fact that it hasn't got any major tech companies, like the DAX has, for example, and Nasdaq or the S&P have. I think this is one of the reasons why the FTSE is not doing as well as it should be doing. But I think another reason is the fact that the FTSE 100 is dominated by large multinational corporations who earn their bulk of their earnings abroad. So when those earnings are converted back to the pound, and because of the pound's recent strength, it makes for less, that their earnings appear to be less impressive than they would be in foreign currencies. So that's another reason why the FTSE has a struggle. But the trend is bullish, no doubt about that. Yeah, the 200-day moving average is rising. The 21-day is above the 200. Prices or the index is making higher highs and higher lows, and so I think I would remain bullish on the FTSE, because I think it's got a lot of catching up to do with other major global indices. And the UK economy is doing well. I know that most of the FTSE companies don't necessarily rely on the UK, but the global economy is doing well. It's coming out of a severe recession. So I think that the path of least resistance remains to the upside for the FTSE from here, especially after we formed a couple of hammer-like candles on the daily chart, with the index finding consistent support from the 21-day exponential, and holding above the January high, which comes in at 6,960. This level right here. Previously, I was looking at this area of support, which was previously resistance. We broke above it, tested it a couple of times. One final test here, and it got rejected as it rallied, creating a nice hammer candle. And since then, it has dipped a few more times, but each time it has dipped, people have stepped in to go long on the FTSE. So I think the market wants higher index levels. So the next logical level from here would be the May high, well, this month early high at 7,168. And then thereafter, you have the 161.8 extension from this downswing. And then you have to do that to your time frame chart to see if there are any other key levels that needs to be monitored closely. So from this weekly chart, this level is broken now. The next potential resistance level comes in at 7,218. And then this level here, which is the base of the COVID breakdown. That would be an interesting level to see if we get any reaction around. But yeah, it's kind of recovered a bulk of its losses, but it hasn't broken out to a new high yet. It may do so in the future, but it hasn't done so yet. Meanwhile, if you look at the DAX, it has cleared resistance. We were talking about this area of resistance previously, and we got a bit of a downside follow through, but it never broke through the previous low to create a bearish structure. And instead, it rallied and took out resistance. So now any dips back into this former area of resistance could be bought, leading to fresh record highs for the German DAX index until we get a lower low. So this was the most recent low. I can move this up to this level here. So the line in the sand for the DAX is at just below 15,000, which would be if that level is breached, then we can talk about playing the bearish scenario. But for now, the bullish scenario remains the more dominant trade for the German DAX index, even if we are at record highs and overbought levels.
So what about the US then?
Yeah,
have a look at the S&P. Yeah.
S&P, like the DAX, it's also trading around the 161.8 extension of its COVID-related lockdown drop.
And we're seeing some obviously correlation between the two, but the US index has been leading this rally. And just last year we had the DAX catching up at the end, and basically as soon as the rotation trade started, because obviously while there are some tech companies in the DAX index, most of them are more concentrated on the value sector. So we have seen some correlation there, but yeah, the S&P 500 is still looking constructive. We've had two attempts to go below for the 4,050 area, between 450 and 440 and 460 really, and those have been sustained. I mean, the declines have been reversed, and another visit at the all-time high at 4,244 remains in sight, despite all the talk of a stronger correction. We haven't seen one so far, and the main trigger for that really probably is going to be change in the tone by the Federal Reserve. As soon as they announce some form of tapering, there may be a more pronounced correction. However, for the time being, there doesn't appear to be one in the cards, and we're seeing this rally going on. Keeps printing higher highs, and as long as volatility is pretty low, as it has been recently, it's this rally still has legs. So yeah, the key area to look at for supports is this trend line that Fawad has just drawn, and it intersects with the recent lows around the 40-60 area. So for the time being, that will be one area of focus when a decline, a sharper decline happens. This is probably the first place where you want to look at to attempt to buy the dip. In the meantime, the 42-44 area remains resistance to the upside, and near term, probably buying a dip towards 41.83, which was the previous high, could be a shorter term play for those of you that are looking to place shorter term bets. So
yeah, I was just going to say that if we, for those who are active, if the low of the yesterday's hammer bullish engulfing candle breaks, that could lead to a drop to the trend line. So watch out for that possibility as well.
Yeah. So why don't we have a look at gold? This is a very interesting pattern in my view, at least. I mean, it still can go both ways, and I expect this to be a rather sharp move either way, because we've been trading in a tighter and tighter range, and this is going on around this key 50% Fibonacci level that
Sorry, I've just removed
is around.
it.
No problem. Yeah, we had this break of the trend line around for 1850, and the 1860 70 area was pretty I would say we saw some pretty good two-way action there. Buyers and sellers continue to duke it out and to resolve this tightening formation. If you look at it on a smaller time frame, hourly or 4-hour charts, this has been a very brutal range, and we're getting close to a resolution, I would say. Either way, I expect to see a lot of stops on either side of this break, and one has to be careful not to place bets without any risk limiting orders. So we have certainly some stops below the 1870 area, and some above the 1890 area. So this has been the range that we've been looking at over the past week, really. So
Yeah. So far within this consolidation, I would say the price action remains quite bullish. If you look what happened here, for example, it tried to break out this low, break through this low. It did break, but couldn't hold, and it rallied sharply,
yeah.
Came back to retest that level. And since then, it has been creating incremental higher highs and higher lows. And so that to me looks like it's possibly building up for or gearing up for a potential breakout to take out liquidity resting above 1890 area. And then the next level of resistance, as we can see on the daily, comes in at 1900. And if we move that across to the daily, to the hourly time frame, that is where it could break out to and target before coming back down.
Right. So yeah, I guess we covered pretty much most of the asset classes
Absolutely.
for the day. If you have any questions, we'd be happy to comment.
Yeah. So this is one of the reasons why joining us live is better than watching a recording of this, because as we talk about these markets, you can ask us questions and ask us to cover markets that we haven't touched on. For example, crude oil we haven't looked at today because of lack of time. But make sure to join us next time. If you go to our website at Think Markets, you will see a list of upcoming webinars. Go to market analysis and live webinars. Here you will see a list of upcoming webinars that you can register for. So make sure to join us for those ones, please. And in the meantime, you can get in touch with us through Twitter and other social channels. But as we mentioned at the start of this webinar, this week it's going to be quite quiet in terms of macro events. So expect to see some choppy price action as we now enter the middle of the week. The RBNZ meeting on Wednesday is going to be very important for the New Zealand dollar. But Friday we'll see the release of some important macro data from the US, which should move the dollar. So those are the key events to look forward to. Please try to be careful out there. It's going to be choppy. And right now,
actually, that main takeaway, that the main takeaway from what you just said is that until we see some form of catalyst for the next move in the dollar, it's unlikely to move not that much. So fake breakouts. Just like this morning, could
maybe it's best to look at cross
some other pairs. Sure.
Yeah. So, for example, one of them would be the Euro-Yen, which continues to show a very strong trend, and each time it goes down, it the buyers step in right where they should. For example, right here, previous resistance turn into support, and it breaks out. Euro pound yen is another one to look out for, which is holding in a tight range. So this could be about to break out as well. So you don't have to trade the dollar if you're unsure about the direction. Just pick a cross that makes sense to you and try to make the most of that rather than worrying too much about the direction of the dollar. Anyway, thank you so much, guys, for joining us. And have a wonderful week ahead. Until next time, take care.
Thank you. Take care. Bye-bye.